to Your Money Matters. I'm Mahima Vachhrajani and you are watching NDTV Profit. Now, today we're going to talk about two very interesting topics. The first one is how to build your mutual fund portfolio from scratch, because our viewers keep sending us queries from asking about very basic stuff as to how many mutual funds should you have in your portfolio, what should an ideal portfolio look like when it comes to doing your SIPs, etc. So we get all of these questions a lot of times. So I thought that, let's try to break this down for our viewers in a very simple language and simple terms. And to do exactly this, we're joined by Kumar, who's the CFA Managing Partner at Zvest Financial Services LLP, joining us now. Harsh, thank you so much, first of all, for taking out the time. Like I said, we get a lot of viewer queries asking that, if I were to build my mutual fund portfolio from scratch today, what should I do? So my first question to you is, from a beginner's perspective, if I were to start building my mutual fund portfolio today, what should be the first aspect that I should look at?
Hi, Mahima. Good afternoon. Thanks for having me. Now, let's first understand lay of the land. So today, if I look at mutual fund universe, there are close to around 580 to 600 schemes in equity category. There are close to around 200 schemes which are in hybrid category, 330 to 340 schemes in debt. And on top of it, we have around 750 to 760 schemes which are available in passive, FOFs and everything. Now, if I add it up, there are close to around 1800 to 1900 mutual fund schemes which are available for any and every investor today. And going through the maze of this is very daunting. Now, before one gets into which funds to get into, the idea should be that one should get into the broader picture of the portfolio. So how should one go about it? Step one should be to understand what are the goals of an individual, what is the time horizon an individual has, and what is the kind of risk appetite one can withstand with respect to volatility in the portfolio. And basis this, step one should be deciding asset allocation. Once asset allocation is clear as to how much should be in Indian equity, offshore equity, gold, silver, other things, then one should get into deciding which funds to have in the portfolio, and that's how one should proceed. Now, this is true for investors who are starting to build portfolio, which have goals which they want to fulfill from the portfolio. But for somebody whose goals are already taken care of, that individual should proceed in a way to optimize return at a given level of volatility that one can tolerate.
Okay, here's the other aspect. A lot of people who speak to us kind of are confused because they end up doing small amounts of SIP in a lot of mutual fund, which eventually go and overlap, right? So what is the ideal number of mutual funds that you should have in your portfolio, and how should this number be diversified exactly?
So if you would have asked me this question 10, 15, 20 years back, I would have said that, 5 to 6 funds are good enough to do justice to the portfolio. And the reason is in those days, the funds were not true to level. So you could take one large, one mid, one small, one debt fund or one hybrid fund. And you could have seen that you could have got diversification, because beyond these funds, if you would have chosen, you would have a large cap fund with a mid cap overlap, mid cap fund with a large cap overlap, and those kind of things. Those were also the days when tracking the portfolio used to be on Excel sheet, and which was not very easy beyond 5, 6 funds. But while we speak today, I think the number of funds have to go up. And the reason is that Indian market has evolved and is in the process of evolving. Unlike the Western world, where most of the evolution in this space has happened in last 30, 40 years, India is still going through that process. So today, while we speak, one has an option of choosing offshore funds, and one should choose offshore fund because a lot of our expenses are dollar denominated, be it about our Netflix subscription, buying jewelry, buying gadgets, sending our children to outside India in terms of education. We need dollars in the portfolio, and that's why we need maybe 1 or 2 offshore funds in the portfolio. Second, if you see the kind of evolution we have seen with respect to the funds which have come up in the market, 10 years back, there was no silver-based fund. We didn't have any quant-based fund. We didn't have this kind of a universe for passive funds. We didn't have smart beta at all. Now, if you want to take advantage of these, you may need maybe 1 or 2 funds in this category also. On top of it, large, mid, small, all these funds are true to label now. Now, if you see the number of companies which have got listed in India in last 2, 3 years, that also is the reason that you should have maybe 2 funds in mid cap and small cap. Because just to give you numbers, in 2025, we had more than 100 companies which came to the main board. In 2024, we had close to now 94, 95 companies which came in the primary market. Now, if you want to invest into newer ideas, you need a lot of research capability, and one fund can't do justice to that. So you need more funds there as well. Lastly, if you see the style, the way they have been panning out for last 4 5 years, we need more than one fund in each category to offer us different styles. Just to give you an example, if I look at last 3 4 years, in US market we have seen growth stocks doing very well. In India we have seen value stocks doing very well. Now, if you were on the other side with one fund in one particular category, and you would have been underperforming on your portfolio. So, if you add all these factors, I think in today's time, having 10 to 15 funds is not a bad idea. But the point here is where you started with, that this should be offering meaningful diversification. So, if your portfolios have overlap, if the correlation in your portfolios is very, very high, in layman term, if your funds are going up or down at the same time, then it means you are not diversifying it. So take professional help, see if the funds are truly diversified, and then depending on the complexity in the portfolio, you can take as many funds as it fits your criteria.
Okay, all right. Harsh, the other aspect is that investors keep asking whether to choose SIP or lump sum while building a portfolio. Now, from this, I think my understanding is that SIP is a must; it's a non-negotiable, right? But when it comes to lump sum amount, let's say, for example, by the year end you get a bonus. That's the time you go ahead and invest that lump sum amount as well. How does one, put into perspective this strategy perfectly?
So there are two dimensions to that, and you touched upon that. One is the cash flows of an individual, and second is the valuation in the market. Now, suppose you are in a profession where your lumps are higher than your monthly cash flow. For example, if you are in a startup and you are dependent on your stock options liquidity, then you will get a lump which is going to be far higher than your normal salary. If you are a celebrity, if you are in a profession like you are a cricketer, like you're a sports person, you may get money for 4 5 times in a year, and you have to manage how to effectively deploy that money. If you are in a job where your bonus is far higher than your monthly take home, then also you are dependent on deploying lumps. Now, you didn't touch upon one particular way of investing, which we can also discuss, which is called STP, which means you are getting lump sum, you want to deploy it into the market because you know that you are not getting monthly cash flows to do SIPs. If the valuation is good, you can deploy it immediately. If the valuation is little stretched, you can do systematic transfer also, where the money moves to liquid fund and from there you move to equity fund. Now, this is about somebody who's getting lumps, somebody who's dependent on his monthly cash flow for his investment and doesn't rely too much on bonuses or one-time windfall gains. That individual should definitely focus a lot on SIPs, because SIPs not only take care of the volatility of the market, but they also take care of the behavioral aspect. Market is expensive, market is cheap, you want to book profit, you want to stop your SIP. Those kind of things are generally taken care of if things are automated. So if you ask me, the best strategy is your portfolio foundation can be via SIPs. And whenever there is a market correction like what we have seen in last 1 to 2 months, you can add up or top up with some lumps as well.
Okay, all right. So that sums it up well, very well, Harsh. That how should you differentiate and use both of these strategies hand in hand. The other aspect is as to how do you determine the right mix between equity, debt, as well as hybrid funds. For equity and debt, we've always talked about the age minus 10 rule, right? But when it comes to these hybrid funds as well, how do you approach it with the right strategy?
So a lot of people say that 100 minus age should be your equity allocation, but I respectfully disagree to that, because age is just one variable in terms of deciding how much risk you can have in the portfolio, and it's not the only variable. Now, how we would analyze this particular thing? One is, I would look at risk in two dimensions: ability to take risk and willingness to take risk. And second aspect for me to decide this would be, what is the kind of holding period an individual has. So, for example, if one has ability and willingness to take risk on the higher side, and the holding period is more than 5 years, then the portfolio can be heavily skewed toward equity. If the time period is 3 to 5 years, then one can have a healthy mix of hybrid. If the time horizon is less than 3 years, then debt oriented funds can be a major part of the portfolio. On the other hand, if an individual has less ability and less willingness to take risk, irrespective of the time horizon, a debt portfolio or debt oriented scheme with hybrid should be the major allocation. The idea of the portfolio is that it should not give you sleepless night. It should not become an health issue for you. So you understand your risk appetite and not just your age rule before deciding how much you should allocate across these three categories.
Okay. And is diversification across fund categories more important than chasing returns? How does that work?
Definitely, it's very important. So often investors commit a mistake whereby whatever asset would have given return in the previous year, they end up taking lopsided exposure in that. Or even the funds which would have done for last 1 year, done well, they would take higher exposure in that. So I was just going through a study which was done by DSP Nitra, which said they took the data for last 13, 14 years, and they realized that in every 3 years, more than 67% of the fund in each category move from quartile one to lower quartile, which means if you're chasing the previous year's good funds or previous year's good asset classes, then you may end up getting disappointed more often than the rewards of that, which may make you happy. So the ideal thing for you should be you should have your eggs across the baskets. And it doesn't mean having more number of funds, but go by your asset allocation. For example, last year in 2025, somebody who had portfolio only in mid and small cap basis the performance of the previous year would have been disappointed. But somebody who had money in gold, silver, real estate through REITs or in offshore equity would have still beaten inflation in India versus somebody who was only in small cap and mid cap.
Okay, fair. Harsh, the other aspect is if I have and I do SIPs every month. In how much time period should I review and rebalance my portfolio? What is the ideal time period?
So review should be once every 3 months. And rebalance should be either once every 12 months, once a year. You can have a calendar around that. Or if there is too much of volatility in the market and you feel that your asset allocation mix is getting distorted, you can have a rebalance before that also. So ideally, when you decide your asset allocation, you don't decide a single number. You can decide like, I want to have 55 to 65% in equity. I want to have 20 to 25% in debt. I want to have 7 to 12% in precious metal. And if you see that you are deviating from that range, you can do the rebalancing. So you should treat it like a health checkup. You don't get it done every week or every month. You should define a frequency which is once in 9 months, 12 months to take care of these things.
Do you deal with underperforming funds? Do you scrap them off immediately, wait for a while? How does that work?
No, so definitely not. So if there is a 1 year underperformance, it's not that we need to remove that fund from our portfolio. But before getting into the underperformance, you should understand what are the reasons for underperformance and how long has been the duration of underperformance. So I would get skeptical about a fund provided there are 4 or 5 reasons. Say for example, one, if there is a change in the fund house or fund house's strategy, then I would want to analyze the new strategy and take a call. If there is a change in the fund manager, because of it we have seen a lot of fund manager changing fund houses, then also I would want to review my portfolio. Third, if there is a merger or acquisition of a fund house, then I would want to see what is the ideology of the acquiring fund house and whether I want to continue with that or not. Lastly, if there is a underperformance against benchmark and against peer, which is continuing for a market cycle, then I think you can review that and you can decide whether you want to exit that or not.
Okay. How does an investor avoid over diversification, Harsh?
So there are two ways. One is looking at the correlation between the funds. You can check it yourself or you can take professionals' help to decide whether the correlation is high or low. Second is you can look at the overlap of the stocks in different funds that you have. So ideally, high overlap and high correlation means you are not truly diversifying. And like I discussed earlier, if your two funds are moving in the same way when the market is going up or coming down, then you don't need those two funds. You can do justice with one fund itself.
Okay. Apart from that, Harsh, what are the key mistakes that generally people make while choosing a mutual fund, and how can they get rid of these mistakes?
So, Mahima, first and the foremost, the biggest mistake which is committed by individuals these days is they don't believe in asset allocation. So, normally individuals go by last year's top performing funds or top performing asset classes, be it about equities or about crypto or about precious metal. They just chase what has been done last 1 year and they start investing in that. That should be avoided. One should have a very, very clear asset allocation framework because there have been numerous studies, some by even Nobel laureates, which say that asset allocation is the major generator of return over a 20-25 years period, and not the selection of stocks or selection of funds. So these are one or two important things. Second, when there are corrections in the market, if you end up stopping your SIP, if you end up redeeming your fund, that is again a classical mistake which people do. And on the other hand, when there isn't too much of exuberance in the market, when everyone believes that India is the only place in the world, that's where mistake happens, because you over allocate into India or Indian equity. Lastly, checking your portfolio every day, comparing your portfolio return with your neighbors or friends is again a mistake, because each one to its own. You can't have, same return at a different level of risk which the other is generating. So if you follow these 4 5 things, where you track your portfolio once every 3 months, have a fundamental approach to asset allocation, you don't chase return, but you chase good quality processes and good quality fund managers, I think your journey over a 10-15 years period can be really rewarding, and it can surprise you on the positive side even more than what you can even imagine.
Okay, Harsh, thank you so much. I think this is going to benefit our investors and viewers who are watching this, build their portfolio from the very scratch, and you help them understand it in a very easy and simple language. Thank you so much for taking out the time and helping us answer all those questions.
Thank you, Mahima. Pleasure is mine.